On recording. Hi, everyone. Welcome to the Seattle Angel Conference Workshop Series. Our um, focus is on creating new angel investors at the pre-seed level. And we do a bunch of programs around that, but we do a lot of education as well. You found the meetup group that got you here, so that's where we're doing most of the discussions. I want to spend a little bit of time framing the investor process. So I heard one of our folks here say we're going to pivot from angel investing to looking for angel investing to bootstrapping. Let me first say that you should always be bootstrapping. The fundamental thing of what investors are looking for is amplifying a process that's already working rather than funding a process in a garage that's not put together yet. And so when you frame it as bootstrapping versus angel investing, I think you get yourself in trouble. The key for angel investing is that outside people are going to take a minority share in what you're doing, and then they're hoping that that's going to be a big amplifier. And if you don't have a thing running, there's no amplifier to do, right? Taking and building the store that linearly proceeds down the being a store business is not angel investing because it's not an amplifier. It's just basic operational costs. So that's the first foundational thought I want to make. The second thought that I want to make for founders is the deal terms that you do to raise money from whoever, if you're doing friends and family money, if you're doing angel money, if you're doing VC money, if you're doing bank loans, the choice of the deal terms is up to you. And so you should understand clearly the pathways that are there. And normally you'll hear as a founder, we're going to come in as a very early company into angel investing. We're going to do a convertible note or a safe note, and we're going to then go on. And in that go on is the assumption of venture capital funding. And it is not necessary that it is not necessarily true that to get angel investing that you need to do venture investing in order to produce the reasonable returns for the angels. And so you should think about it in a broader way because we have, just be clear, 98, 97% of angel investors are going through Reg D 506B. And some little tiny are using Reg D 506C, which is private solicitation versus public solicitation. And that distinction is important for you to know. But there's a lot of other choices. You could use Reg D 504, or you could use Reg A plus, or you could use Reg CF. All of these exemptions your lawyer should know about. And we're going to talk about that distinction today, about where you're going to go. Interestingly enough, the senators that created a bunch of these regulations at the Fed level think that angels or companies are starting with Reg D 504, which is local investment in your local state, right? And not federally organized funding, which, as far as I know, nobody in my world has ever done that. So how the people that created the rules think the rules are supposed to work and how we use the rules are not in alignment. So what we would like to do is figure out where the rules are and how they work, and then talk about what the opportunities are for the founders to pick a path that will be successful for them to amplify their business to create exponential growth and scale. And with that foundation, Jay, if you would like to introduce yourself and then walk right into the conversation and share your slides and go forward.
Definitely. So thank you for that, John. Very insightful information. I really appreciate being on the inviting us to do this education for your viewers. And I'll just give a little bit background on myself. My name is Jay Waterman. I'm the CEO and founder of Blockstation. And basically what we do is we work with stock exchanges as a fintech. And what we do is we provide them with a very powerful solution using all the latest technology so that the stock exchanges can be really efficient. And the reason for this is because, you know, stock exchanges over the last 10 years have been essentially declining in the number of listings that they're doing. And those declining listings has a whole bunch of other repercussions that we'll talk about as we go forward. But at the same time, companies that list on the stock exchange often have the most access to capital. And I'll tell you a little bit about how I kind of got interested in working with stock exchanges and interested in the stock exchange as an entrepreneur or a serial entrepreneur. One of my businesses was a ERP solution, which is actually still going on now. It's very supportive of what we're doing with Blockstation in terms of making sure that all our operations are really streamlined. But we wanted to really grow this business. And when I looked into what it looked like to do a listing on the stock exchange and raise capital, like my competitors, NetSuite and SAP, who were doing tons of business, I realized that the process of going public was really difficult. It wasn't friendly. If I wasn't part of the club, it wasn't something that I could even get into. It's really expensive. And there's all of these different problems behind it. I'm just gonna jump into my slides, segue into there. One sec. Are you able to see my screen?
Yep, looks good.
Okay, perfect. So, as an entrepreneur myself, seeing what NetSuite and SAP were doing in terms of their numbers, knowing that I have a better product and service, I was like, how can I access this capital? And so this was something that stuck with me for quite some time. And this is like 25 years ago, by the way. And that kind of was the foundation of building Blockstation, which is making the stock exchanges really efficient so they can pass that efficiency back over to the early stage companies. So back in 1981, the Home Depot, which is a massive conglomerate now, went and did their IPO on the New York Stock Exchange with just a $60 million valuation. For context, these days, nobody is doing a $60 million valuation IPO on the New York Stock Exchange. You will have your lunch eaten. So, of course, angel investors are all excited to invest in different companies and get that big exit. But the reality is, stock exchanges used to be friendly for not only the exit, but the entrance. And this is important because if you enter into an investment that is on the stock exchange, your exit is already set up because you have the ability to trade. So I want you guys to think about for angel investing could utilize the stock exchanges not just for the exit, but for the entrance. But there's going to be a number of things that we're going to have to mitigate in order to do that. Now, in terms of angel investing, I'm just curious, maybe you guys, the angel investors on the group, you could just put in the chat some of the top reasons of why you do angel investing. Now, obviously, everybody, is going to be looking for a ROI, but I know that there's a lot of other reasons as well. For example, for me, I really like the mentorship. So when I'm investing in a company, I love to, invest in the young entrepreneurs, not just my capital, but spending time with them to teach them, give them the knowledge necessary in order to succeed. And that is fulfilling to me. But there's many other reasons, and I'd like to just hear from you guys some of those reasons. You can just drop it in the chat. John, what's your number one reason, by the way?
Yeah, I invest because I am interested in building local economies and keeping more money local to the local community by getting angel investors locally to benefit from when companies get big and to make the local economy involved in the innovation economy. And that's part of why I grow new angel investors.
Okay, great. So I would put that under strengthening the ecosystem and specifically your local ecosystem, which is powerful. Thank you for that, John. So the Ron Wiseman, who's the chairman of the ACA, it's a group for a number of angel investor groups. He says that the road to a mega exit is tough and is riddled with challenges. is riddled with risk. Getting that big exit for a $1 billion IPO or multi-billion-dollar IPO is typically not what happens. And so we need to think about how we can exit the investment in a more realistic fashion, because most of them are not going to be that mega exit. Now, the problem is that less than 5% of companies, in terms of startups, are going to result in a successful exit. And if less than 5% of companies are resulting in a successful exit, what's happening to the capital that you're investing? How can you continue to invest in more companies to build up the community, to build up the local ecosystem, all those type of things? We need to increase the amount of exits. And over the last 5 years, the amount of exits have been continuously decreasing. So this is both for, and especially for IPOs. So this is important. In terms of the type of exits, typically the main exits that we're going to see is some type of merger and acquisition, which has its own challenges, can take quite a long time. Usually has only a few buyers that are potential, acquirers of your company. And one of the difficulties is a lot of the times with the M&As, you're giving up control, you're giving up the company, you're walking away. Sometimes that might not be what you're looking for. The other thing is sometimes the competitors are your best potential acquirer, and after going through and providing all your trade secrets, the deal could fall through. So it's not without its own risks and challenges, and a lot of businesses end up almost stop growing while they're dealing with the M&A, because it takes a lot of work, a lot of energy. There's risk associated with it. Then you've got the IPOs. IPOs, as I mentioned, are really expensive and takes a lot of time. But the good thing about the IPOs is you can access a larger group of investors, from institutional investors all the way to the public. And so this is what makes it attractive, but the costs typically just makes it unbearable, and it's just not possible for early stage companies to take on and do an IPO. So these are some of the barriers to an exit, for the most part, IPOs, and how we're addressing some of these things, utilizing the latest technology and utilizing the right strategic partnerships. So the first one is expensive audits, and I'll give you some context. So I was looking for auditors to do an IPO for one of our partner companies. And the stock exchanges typically have a select number of firms that they're authorized to do these audits. And so I didn't go to the big four. So the EY and the PwC and those guys are out of the question, because they're going to be way too expensive. So I was looking at the lower tier of auditors. And I gave them the scenario that this is a brand new company that's going to be acquiring an asset. For the year that needed to be audited, they had a single transaction, $100 deposit into the bank account to open the account. That's it. There was no other transactions at all on the books and records of the company to audit. That audit was going to cost $50,000 in order to get the right credentials to go onto the stock exchange. And that just puts it way outside of the realm of any startup. So some of the things that we've done is we've developed partnerships with stock exchanges who are our partners, and worked with them to create the rules to make it friendly for early stage companies. So now the rules allow for any licensed CPA to do the audits, and that will be accepted by the exchange and regulators. And so that can cut 80–90% of the cost of what typically would happen if you wanted to do an IPO. We've also partnered up with Moss Adams, which is one of the leading firms in the US, and they are also working with these startups in order to make the audits very cost effective and friendly for these startups. The second challenge is you got to get a broker dealer. Anytime you're doing an IPO, you have to get a broker dealer. And, what I'll say is that these brokers often already have their pipeline of business and who they take their business from, because they want the lowest hanging fruit with the highest potential return for them, often is the case. And as an early stage company, you typically don't fit that bill. So what we've done with our partner stock exchanges is they have these broker-dealer networks that are members of the stock exchange. And these broker members are friendly to early stage companies, and they're looking for new business and looking to work with these early stage companies. So we solve this problem like this. The third issue is disclosure requirements. If you've not, some of you may have heard of a Q10 and the different filings that you have to do if you're doing an IPO or going public in the US. And these have to be formatted in a specific way. They need to be filed in a specific way. And the costs associated with doing these filings are really expensive and it's very difficult. And so what we've gotten with the stock exchange partners that we have is we've had them basically accept quarterly financial statements, which I will say any good company should be making sure that they're taking care of their financials on a monthly basis. Otherwise, you don't know what your burn rate is. You don't know if you're making profits or not. You don't know what's going on if you're not keeping track of your books and records. So to be able to just keep track of your books and records in a very normal way and file those quarterly reports plus the annual audits is something that is actually more reasonable and accessible for early stage companies. Number 4, naked short selling. I'm not sure how many of you guys have heard of that, but it's not trading stocks on the computer with no pants on. It's a process of market manipulation that unfortunately a lot of companies are subject to. So if you know anything about short selling, basically the concept of short selling is when an investor doesn't believe that your company is going to be doing well. They think that your stock price is going to go down. And so what they do is they borrow the shares from somebody and then they sell those shares on the market. So they borrow it first and then they sell it. Now, naked short selling, the problem is that they don't borrow those shares. They don't have to borrow the shares, they just sell it. Now, when they just sell it, this is detrimental to companies. And I'll just give you a real story. And this is just from 2 weeks ago. I was speaking to a gentleman. They had a really successful business and they were excited to go IPO. They did their IPO on the NASDAQ. Within 2 days of that IPO, they had sold, after the initial IPO, they had about 2 million shares that were issued and outstanding. Within a couple days, about 10 million shares were sold on the market. So the question is, how can somebody sell 10 million shares if only 2 million exist? And this is the problem with a lot of the capital markets today is they don't have mechanisms to stop that type of manipulation. Unfortunately, these naked short selling activities can go on for a long time, and that short selling pressure drives the company's stock down. And when the company's stock gets driven down, then it's very difficult to raise capital at any reasonable price. The whole reason why most companies will go public is so that they have access to more capital. But when you're subject to that type of manipulation, it messes everything up. So when we utilize the blockchain, which is what we do with our stock exchange partners, our technology, what happens is it is not possible to do this naked short selling at all. The blockchain makes it too transparent and too traceable, so nobody can do this type of manipulation. So you just prevent
Mel,
that
why are you taking
altogether.
notes? You're not gonna get rich from this, bruh. This is fucking waffle, man.
Uh,
You
I just
guys think
heard
you're gonna get
somebody.
rich from this fucking stupid ass Zoom? It's stupid, man. You're all NPCs. Fucking log
No,
out.
no,
It's a waste of
start,
time. Find your own
stop.
thing to do.
No,
Is that somebody talking somewhere else?
And to
no,
Blockstation. The fuck?
Guys,
it's,
this is a scam. This is a scam call. Everybody leave. This is a scam.
so we're not
Oh,
having fun with people here.
is that the reaction to blockchain? Are some people scared of the blockchain technology?
Yes, crypto is a scam.
Yeah, so we're talking about startups here, and we're not talking about crypto. We're talking about utilizing a technology, okay, in order to prevent scams. If you look at BlackRock, if you look at JP Morgan, all of them are now using blockchain technology because of the transparency that it provides. Okay, so you should understand what is going on in the markets. You can go and do your research, look up naked short selling. Naked short selling is illegal. If something is illegal in the markets, the question is, how do you prevent this
Naked
illegal
Go ahead, look at
activity
naked
from
what?
happening? Pardon?
Keep going, Jay.
Yeah. The question is, how do you prevent the illegal activities from happening? You have to use technology. You can't have a bunch of people scouring manual records. You got to use the right kind of technology in order to mitigate the risk. And blockchain technology does that. And that's why you have all countries across the globe, central banks are adopting blockchain. The stock markets are adopting blockchain. The biggest institutions in the world are adopting blockchain. This is the reality. And so this is one of the ways how you can prevent naked short selling. Then you've got issue number 5 is the time it takes in order to execute on an M&A or an IPO, as I mentioned before. This
Yo,
can be
Ramel, I know
quite,
you've turned your camera off, but you better not be making notes.
yeah. So if you have some questions, then we're happy to answer your questions, but please be respectful. Because there's actually real businesses and real investors that would like to learn about how they can mitigate more
Yeah.
risk and get more exits.
Yeah, I'm sorry. We have people who are not being respectful, so I'm closing things down a little bit so you can talk.
Okay,
So when people want to talk, you should raise your hands, and we'll work with that. So be, please explain enough about blockchain so that we can understand what the key aspect is that makes this useful.
Yeah, great. So this is what I'll say in terms of the blockchain. The blockchain creates a system of consensus. And consensus means that you have multiple parties who are keeping track of a ledger. And I'm going to give you the example of, typically I do this physically with money if I'm physically there with a crowd. So you have a situation where everybody wants to know what is the truth of the matter in terms of how much uh, shares are issued and outstanding. And so there's a ledger. So just imagine a database or an Excel sheet, which is keeping track of who has what. If you have a single ledger, then it's possible that it could be easily manipulated by the people who are running that ledger, or an intrusive hacker could go in and change that one database and it changes, and unfortunately, you could have certain kind of repercussions. On a blockchain, what happens is you have a million different individuals or individual computers who have a copy of the ledger. And there's a consensus mechanism where everybody votes together to agree that this is the amount of shares that are issued and outstanding. This is how much that is issued in this wallet and that wallet. And everybody agrees. And when you have a consensus, then transactions are confirmed and it creates a lot of trust. That trust is why you have central banks across the globe and stock exchanges across the globe and financial institutions like BlackRock who are all adopting blockchain because of the transparency that it brings. So in the case of somebody who's trying to do something malicious, like go and change the record, they now have to go and hack maybe a million different computers or a million different ledger holders in order to mutate that information and create any type of manipulation. So the blockchain is a very powerful consensus mechanism that brings trust and transparency, whether it's to currency or whether it's to securities. And securities is probably the most important use case of blockchain, in my opinion. And yes, blockchain has been associated with some negativity like meme coins. I talk about that. Unfortunately, the truth is most of the meme coins, from my perspective, add no value to this world. And a lot of them are just scams or what they call as rug pulls. And so the important thing is people are investing in these things because at the end of the day, they're looking for a return on investment. And what you want to do is you want to give these people something real to invest in. And startups are real companies that are bringing real value to this world. They need access to capital, but the people who are investing in meme coins and different scam coins, unfortunately, don't have access to these type of investments because they're not accredited investors. When you take it and you put it on the stock exchange, now they have access to things that are real, and they no longer have to dabble in what I call the things that have no value, bring no value to the world. Unfortunately, often scam people, and is, overall, I'm going to say for the most part, negative. So what we want to do is we want to take the good parts, which is the technology, and we want to use it for something that is powerful, like funding startups. All right.
Yeah.
Does that give some clarity, John?
Yeah, that worked great.
Perfect.
So, fundamentally, you put yourself at a disadvantage when you lead with blockchain, right? Really, what you want to do at some core level is lead with the opportunity to get funding for your startup through other mechanisms other than venture capital. And then, oh, by the way, we secure this with blockchain, just like the Estonians secure their e-residency with blockchain, right? And then leave it at that. But dive back into the process so that our founders and investors can understand this weird thing about doing something different than venture capital IPO on the US market.
Yeah, no, definitely 100%. And these, just keep in mind, these are some of the reasons that we're covering here are the reasons why an early stage company typically cannot do an IPO or should not do an IPO on typical markets because it would be too expensive, too dangerous, take too long, be too onerous. So there's all these different reasons, and we're looking at how we solve all these different reasons to make it possible for angel investors to take advantage of. Another one, number 6, is the market volatility and falling prices. So if you were to list on a NASDAQ, for example, which is a major exchange, you need to maintain a certain price point. And if the price falls below a certain point, then the company would be concerned that they're going to become delisted. So it's important for an early stage company, if they're listing on an exchange, there can't be any minimum price requirements. As the company is doing well, then over time, the market will reward them for doing well, and their price would typically go up. If they're doing not so well, then yes, their price could go down. But importantly, the price going down is mitigated when you eliminate market manipulation like naked shorts, which we talked about already. And number 7, one of the most important things, and this is an entry point for the companies when they want to do an IPO, essentially the companies have to build a prospectus. And a prospectus is typically a large document, maybe 80 to 150 pages, that has all of the disclosure that's necessary in order to list on the stock exchange and be compliant. And in order to do this, it could cost you millions of dollars, with lawyers. But utilizing the right technology, then this can be significantly mitigated. Early stage companies can complete their entire end-to-end prospectus and then bring it to their lawyers to finalize. Instead of starting off with the lawyers, they bring it to the lawyers at the tail end to finalize, do the checks and balances, and then you could save 80 to 90% of those costs as well. All right, so we're going to just look at some of the numbers in terms of what the result is in terms of going public. And 84% of global institutional investors are more likely to invest in a company if they're public because of the transparency, because of the governance, because of the liquidity. So this, again, being public opens you up to more types of investors. And of course, in today's world, we know that, the investment, you can say it's getting tougher. It's been tough over the last couple of years. I was listening to Ron Wiseman speak last week, And he was saying he hasn't seen it more difficult times in terms of raising capital than right now. And hopefully that's turning around. But what investors and what small companies want to have is they want to make sure that they have as many doors open to bring in capital as possible. And the investors should want the same thing, because the company you're investing in, you want them to be able to access more capital from more sources. In terms of acquisitions, companies that are public are twice as likely, as getting acquired. And again, that's going to go back to the same things. A company that is public has transparency, they have a clear price discovery. So a lot of the work associated with an acquisition is actually already done because the company is well governed and very transparent, making it more attractive for companies who are looking to acquire. And so this is by Refinitiv. Then you've got access to more capital. So it's stated that about 30 to 50% more capital is available to companies that are public. And this again is because you have access not only to the angel investors, but also institutional investors, and you have access to the public. Okay, and then in terms of the valuation of public companies is typically in the range of 20 to 35% more than a private company. So being public, not only do you have access to more capital, but you also have a boost in your valuation. Of course, being public does have its responsibilities, as we mentioned, in terms of reporting and getting those audited financials, but we mitigate those by bringing the costs down and making those reporting requirements very reasonable through the right partner stock exchanges. So now we're going to take a look at what the path looks like if you were to do this compared to the traditional path. And this is, we're looking at the example of an angel investment group like Seattle Angels, who's looking to invest in a company. So there's a lot of similarities at the beginning. So you're going to still have your regular deal pipeline in terms of how you source the different companies. You're going to do your deal screening to look at the different types of, to filter out the companies to the best ones. So maybe you end up with, from 50, you end up with 3 companies that look really good that you want to do diligence on. You do the due diligence on those companies, and you end up picking one that you're going to invest in. And this is where the paths diverge. So the typical path for angel investment groups is they're going to go down the path of creating a special purpose vehicle. They're going to create that vehicle, put the money in the vehicle, and invest into that company. This investment vehicle is going to have a cost associated with it, as well as some maintenance. The other path, which is new, utilizing the tokenized IPO method, is the company is actually going to list on a national stock exchange. So just to be clear, this is not a crypto exchange. This is a national stock exchange, somewhere in the world that is accepting international companies and looking to grow those markets. And so these international stock exchanges is where the company can list with these more friendly terms, meaning there's no naked short selling, it's more cost, it's affordable, etc. Okay, so once the company lists on the exchange, then the individual investors can invest into that company through the broker, and they don't need to create the SPV. They can invest directly into the company directly through the broker. So after the investment, we're just going to compare those 2 different paths. So the typical path, I'm sure all the angel investors on here know this, that you might be looking for a 5-year horizon and hoping for an exit. But the reality is most exits are, much further out. I'm hearing average in terms of 15 to 20 years, which is not typically what, the investors are looking for. There's no liquidity in this path, and there's no transparent reporting necessarily. The companies have no requirement typically to do reporting, etc. And so you have limited ways of mitigating your risk because you have no path to an exit. You have more so just hope. And of course, along these 5 years, assuming it's 5 years, there's all these different things can happen, good and bad. They could have a new product launch, but they could maybe not have any product market fit, right? They could have a new strategic hire, but the founders could also burn out. And for any of these negative reasons on the bottom, the company could go out of business and you lose your entire investment. And of course, every accredited investor understands that that is a risk. But if they were on the public path, you would have the possibility of exiting, right? So you have liquidity. At any point in time, you can put in your sell order on the market. You've got some liquidity. There's price discovery, so you can understand as the company is progressing, you can understand what the valuation is. It's no longer a guess anymore. You have transparency because the company is required to report on a quarterly or an annual basis. And there's something that's interesting here as well. Aside from the companies having more access to capital, et cetera, is there's a potential opportunity, I'm going to say as an angel group, and this is a more advanced technique, but they could do what's called market making. And market making is basically essentially buying and selling. You want to keep your position. So just imagine as an angel investor, you guys invested into a company. You're looking for this company to succeed over the next 5-year horizon. You're not looking to exit tomorrow like a flip. You're looking for this company to reach certain milestones so you can get a 10x or 100x or whatever that multiple is that you're looking for. But along the way, you could buy and sell as the company is progressing, keeping your position, but making a small spread along the way. And based on typical market makers, over about a 5-year period, you could actually recapture your entire return on investment while at the same time maintaining your position in that company. So this is something that also could be looked at and talked about further.
So before you go on, I want to summarize a couple of thoughts. One is you can avoid the costs of doing an SPV, or at least you can change which costs you have by doing SPV by listing on the market. But it's not necessarily true that they have to be alternatives to each other. We could do the angel investment in our normal angel investment way and then go public via this mechanism later, right? And so there's flexibility in here. It's more broad than what you're laying out. Is that correct?
That's 100% correct.
Yeah, and I see Vikash also has his hand up. So when you're ready, we can turn on Vikash.
Sorry, could you repeat that?
Vikash has his hand up.
Oh, okay. Go ahead.
So I turned off muting, so I'm not sure how to undo that. Hold on a second.
Yep, I think
There
I
you
can
go.
speak.
Okay.
Thanks, John. Thanks, Jay, for this informative session. Jay, I had a basic question. Like this sounds a great choice for the startups, right? Like to list themselves on the stock exchange and give that liquidity option for the investors. What was the, maybe you already talked about this, but what was the blocking thing that made it not possible so far, and how are you able to make it possible now?
Yeah, so maybe you came a little bit late, but there's a number of issues that startups would face in terms of listing on an exchange, and that this comes down to really two key things. One is cost. There's the cost of audits are too expensive. The cost of preparing the disclosure information when you're listing, you have to file a prospectus. You have to have continuous reporting. All of these things have a cost associated to it. And without having a strategy of reducing those costs by utilizing technology, artificial intelligence, et cetera, then the cost is just going to be prohibitive for an early stage company to take part in.
So
we
how prohibitive are we talking? 100,000, $1 million, $10 million? What does it cost to go public?
Yeah, great question. So the cost to go public, I'm going to go with the typical cost, and I'm going to quote one of my investors who's taken over 100 companies public. He says that you're in the range of typically 250K to $1 million to go public on a smaller stock exchange, and we're talking about audits, legal, listing fees, etc.
And you're talking about the U.S. stock exchange, not like going public in Australia or Canada.
So if we're talking about U.S. stock exchange, I'm going to bump that up more to $500,000 to $2 million. That would be
Right.
more so the range. If you're early stage company, a lot of early stage companies end up going to Canada or other places so that they could get some cost savings. But even those costs are often too much for early stage companies. But even if you can cover the costs, the second thing kicks in, which makes it prohibitive and makes it, I would highly recommend that early stage companies be very wary. And I was telling the story about a company that went public on the NASDAQ. They had 2 million shares that they had issued and outstanding, but somehow 10 million shares are sold. This is called naked short selling. It's illegal, okay, but for whatever reason, the stock exchange and the regulators are not able to stop it. And that naked short selling pressure basically tanks your stock down to a point that it's not a fair value. And unfortunately, it's very difficult to stop because there's people or organizations with a lot of money and a lot of power that can sell your stock down to zero almost. And if you don't have the right sophistication and the right team and the right amount of money behind you, it's very difficult to stop. And unfortunately, a lot of companies are doing really well, but their stock keeps on going down because of this market manipulation. So we stop that by utilizing blockchain technology, which makes things very transparent and it prevents any type of manipulation in terms of somebody trying to do a naked short, because it's simply not possible to do when you utilize blockchain technology. And I know some people don't like blockchain based on the earlier comments, but the reality is it's a technology. It's like some people might not like artificial intelligence. It's a technology. When used right, then it can be very powerful. When used wrong, of course, it could be used for things that can cause damage. Blockchain is a really powerful technology for transparency and preventing fraud and manipulation. All right.
Yeah, move on.
Okay, great. Thank you for the question. All right, so we're going to talk a little bit about the tokenized IPO market ecosystem. And that ecosystem is powered by our technology. So Blockstation's technology, we are a fintech, and we provide technology to the stock exchange, the broker dealers, the regulators such as the SEC, the investors, the issuers, and the depository that keeps safe custody of the assets. So we provide them with the technology front to back, and allows them to operate really efficient marketplaces, which are friendly to early stage companies. So the stock exchanges that we're working with are international stock exchanges. The first one we went live with is the Eastern Caribbean Securities Exchange. Between the 4 exchanges that we're working with, they have over 150 broker dealers that are looking to work with different companies to take them public and help them raise capital. These are fully regulated markets. Again, these are national stock exchanges. They are regulated under their SEC or equivalent SEC organizations. And the regulators also use our software to monitor the market, approve the prospectus, and operate the market as well. There's hundreds of billions of dollars in transactions that go on through these different broker dealers and these different stock exchanges. So these are not new exchanges. These are not organizations that just started a couple of years ago. These are organizations that have been around for decades, and they're looking to move forward with the times because the times are changing, and those who don't change with the times get left behind. So of course, this ecosystem creates time and cost efficiency. This is the reason why the stock exchanges partner with us, because we make it efficient not just for the companies, which we've talked about earlier, but for the exchange and for the brokers and for the regulators, etc. And it's very friendly to early stage companies because of the market manipulation prevention that we have embedded with blockchain, because of the AI tools that we have in order to create your prospectus to make it cost effective. These are things that make it very friendly for early stage companies. And when you make it friendly for early stage companies, it also makes it very friendly for their investors. Because as an investor, you want your companies, that your portfolio companies, to succeed. You want them to have access to more capital, and you don't want them to be subjected to manipulation.
So Vikash is asking about the cost of your solution so that he can compare against it. I also think that he is not clear that you are not using U.S. exchange, so you're not going to buy these stocks through your Charles Schwab account, right?
That's correct. So in terms of the cost for the company who's listing, it will vary because it depends on the complexity of your financials. It depends on how you use the technology so that you don't have your lawyer putting in your name and your address and basic things into your prospectus. You want to use the lawyers wisely. But what I would say is that a company could successfully do a tokenized IPO anywhere ranging from, I'll call it, in terms of out-of-pocket money, not back-end fees because the brokers charge a percentage fee, but out-of-pocket money anywhere from 15K to 25K is very possible in order to do.
And that's USD.
Yes, we're talking about USD.
And one of the problems that I see with what you talk about, there are many different pathways to go public in some way in the US market. But one of the hidden costs of that is that they don't provide market making for you anymore. And you end up being the market maker for your own company. Is that true with your mechanism as well?
So when you're talking about market making, you're talking about bringing investors to the offering. Is that correct?
Yes.
Okay, so there's two scenarios I'm gonna talk about. So there's one scenario where you got an angel group who's already decided they're gonna invest in this company, right? So the money is there. And so they can decide to bring this company to the exchange, and that will allow them to have access to additional capital through that exchange and their broker network, as well as to have the option of liquidity and exits down the line when the time is right. The second scenario is that, a company doesn't have an angel group that's backing them up, but they have a compelling offering. It looks like a business that is going to be really successful. They have a great story. They have traction. They have some level of maturity in terms of corporate governance, etc. Meaning they're able to come to the table and have a board of directors, etc. In that case, if the brokers like what you're doing and believe in it, they will go and get you the money. They have a lot of access to capital in these international regions. And one of the things they like is diversity. So often what happens is in different regions, you have a concentration risk because often the investors in that region only have easy access to companies and investments within that region. So for example, if we're talking about investors in the US, typically they're invested in US stocks and US investments only. They don't have exposure to, Europe or Africa or different regions, at least not very easily. And so through this process, what we find is that because the stock exchanges will accept international businesses and international investors, you can have those brokers are going to take on those companies and use their investor base to help to fill up the round. So, and I'll just give an example of one. So these are current transactions we're working on, and there is a real estate REIT. Okay, so this company is what they do is they go and they buy real estate properties that have 500 to 1,000 units in them. They're a little bit beat up in rough areas, and they have really good returns in comparison to other REITs in the US. But there's a lot of REITs in the US, and it's very noisy sometimes. It's very saturated in terms of, trying to get the word out and trying to get the information out. When they went to the Eastern Caribbean Securities Exchange and they went in front of the broker said, this is exactly the kind of diversity that we need, because in our market, we don't have access to this, these type of transactions. US real estate is something that the investors actually want. And so it was more of a hot commodity. Whereas when they were in the US, it was something that was, kind of just another REIT almost. So in terms of the bringing the investors to the market, the brokers are great for doing that as long as they believe in the deal. And so what we always do is we introduce the companies that we believe are have great potential. We put them in front of the brokers. They pitch to those brokers, and then those brokers decide if there's something that's interesting for them or not. Does that answer your question, John?
Yeah, I think it gets us partway there. The process of creating the market, you're going to have to spend a little bit of effort on your side, but it also creates um, an opportunity for the brokers that are on the exchanges that you're working with. But one of the things that we say we want from angel investors at the early stages, right? We're talking about, barely at product market fit kinds of companies. And in my mind, that's like at the end of seed, right? Then we want the investors to be smart and to be creating value for the startups in some way. And so, how does the investor company relationship change when I go through this tokenized pathway versus, the traditional angel investor pathway, where we're expecting a lot of trust, we're expecting a lot of support from the angels to the company, where perhaps random brokers in random countries far away getting money don't necessarily produce smart investors.
That's why I think the combination is ideal, right? And this is where the two worlds merge. So you've got angel investors and the angel investor groups that are, helping to, first of all, filter out the best companies and then fund those companies and support them along their journey. And that is great. The problem that the angel investors run into is that when it's time to exit, there's no path to exit, or there's no clear path to exit for way too many transactions. And so what we want to do is we want to make sure that that exit path is there, as well as when a company is doing amazing and they need additional capital to further the company, they have access to it. So when you bring those companies that the angel group is supporting, right? So they're investing in them, but they do it through the stock exchange. Then what happens is they're going to continue to support those companies, because angel investors, you're not in it for a quick flip. It's not like you're buying it today to sell it tomorrow and you're out. You're not looking for a quick flip. You're looking for, I'm going to call it a mid to long term, investment to get a large ROI from this, on this company. And so you are going to support them along the way, even if they are on the stock exchange, even if they are getting additional capital through the broker dealers. I think that relationship is going to stay exactly the same. And that is the power of combining those two worlds. The other thing I'll say is when the angel groups have, come together, have a diverse group of people who are looking at the transaction, conduct the due diligence, and cut a check, that can also provide more confidence to the broker to actually bring their investors to the table. So, for example, if a seed company goes to the broker, and the reality is, if it's a seed stage company is going to the broker with no money, that and no investors, it's going to be a tough sell. That's the reality. Okay, the brokers are typically not going to entertain that transaction. But if the company is coming with an investor group that has already done their due diligence and is, cutting a check into that company, you can say is anchoring that deal, then the broker would be like, okay, this must have some good traction. You know what? We're going to support this transaction, and we're also going to let our investors know about it so that they can participate in it as well. So it is much more likely that the brokers are going to support it at that initial tokenized IPO stage if it's coming with the angel investor group's initial investment. The other thing I'll say is once it's public and over the months and the years, the company is continuously putting out information to the market in terms of how they're performing, new contracts that they gain, new strategic partnerships, etc., revenue. All those different things can help to build up the price in the market and build up the confidence of the investors in the market. So maybe in a year's time, the brokers that maybe were not as comfortable in terms of introducing their entire investor base to this investment, they've seen you grow and they've seen your progress over this time. And so as a result, the comfort is there to recommend it to their investor base, which makes follow-on rounds a lot easier.
So I want to make sure that you get to the end of your slides, but I have a couple of more questions. So
Yeah, no problem.
go ahead and finish, and then we'll come back.
Okay, great. So we're just talking about the diversity of transactions that are going on right now with the stock exchanges. Because it's a national stock exchange, you've got government digital bonds that are now looking to move on to the market. So this is probably the largest type of deals that we'll do because it's government looking to do infrastructure. Instead of them going out to the IMF or going out to another country, what they're doing is they're engaging their local public investors who can participate in the market and invest in those infrastructure projects. We've got a mortgage company that is continuously lending, that has you can say it's an evergreen fund that they always have to continue to fill up. And so this is one of the transactions that we're working on. I talked about the REIT already, which is, a US-based REIT in a very, you could say, saturated market because there's too many transactions that look like theirs. So they're having a tough time, but the brokers found it as the perfect diversity for their market. We've got a pharmaceutical company that in their late stages of FDA approval that is in the process. And we've got some small early stage fintechs that are also looking to go onto the market. So it's diverse in terms of the types of companies that are moving to the market. Just for context, in terms of, what Blockstation, what's in it for Blockstation, what's in it for us, we have these partnerships with these stock exchanges, and every transaction that goes onto the stock exchange, we have a partnership and a revenue share with them. So the more transactions go to the stock exchange, that's good for us. And of course, it's good for your portfolio companies because they have additional access to capital. We talked about some of the statistics earlier. Twice more likely to be involved in an acquisition, more liquidity, more access to capital, etc. So it's good for the portfolio companies. And when the angel investor groups, some of those angel investors need some liquidity. It could be an emergency, or it could just be that you reached your goal ROI, or it could be that the company is doing really bad and you want to get out. You have the option to exit. So this is really a win-win-win situation. So just to recap, the benefits that are there for the companies to list on the exchange, more access to public, institutional, and private capital. One of the biggest questions anytime you're pitching to an investor wants to know what's the exit strategy. With this strategy, the exit strategy is very clear. There's a secondary market that they can go ahead and sell on when the time is right. They've got twice as more likely to be involved in the M&A. Increased trust and because of the transparency and the governance associated with being listed. You get a premium for your valuation. You have enhanced credibility and visibility. Sometimes that helps you to get new business as well. Sometimes companies actually go public specifically for that visibility and to win new business. There's a reduced cost of capital over time for public companies because, again, when you're public, it's typically easier to raise new capital when you're public Of course, if your stock is doing well, if you're subject to naked short selling, as we talked about before, which is a market manipulation, and your stock got driven down, that is not a good thing. And that's why we have these guardrails in place utilizing blockchain technology to prevent that from even happening. So it's not possible for anybody to manipulate your company through naked short selling. We're talking about you've got, as I mentioned, a protection against market abuse, and excuse me, future rounds become easier as you build up your credibility with the markets over time. Sorry, one sec. And the benefits to angel investors, of course, they have improved liquidity because they can buy and sell on the market. They have, I'm going to say it's a higher return potential because both, first of all, the valuations are typically get a bump when they're on a public exchange, as well as if it's a private company and you want an exit because things are not going the right way, you have no way to exit. So you have no way to mitigate your risk and reduce your losses. So there's a higher return potential. You've got transparent performance tracking because the companies are required to do their reporting to be on the exchange. So more portfolio visibility, more potential co-investors because you got the institutional investors, the public investors, and I believe even the crypto investors that are currently investing in crypto, really what they want to actually invest in, but they don't have access to, is the early stage startups. Those are the companies that are providing real value to the world and can give a 10 to 100x, unlike the meme coins, which are adding no value to the world and are often what we call rug pulls. So this is really important. More efficient capital recycling. So as you exit one company, you have capital again to go into more companies, so you can do more of what you love and helping these startups become successful. And of course, there's more exits, which is the most important thing. So we'll open it up for more discussion and happy to answer any questions.
Can you drop your screen for a little bit so we can see everyone?
Yep.
So I'm going to come up for a second. So when you go public, you have this reporting and accounting set of costs. And so just the act of going public via Reg A Plus, for example, would require me to have an investor relations person, would require me to be doing quarterly at least discussions back and forth with everyone who's an investor, and I'd have to do some level of accounting. So I add a bunch of costs. Some people think it's somewhere between 150 to 200,000 in just basic staffing to take care of, the fact that I'm now having to do that reporting, and very likely it would grow to be more. How do you see that set of costs for going through your pathway?
Now, the items that you talked about, the biggest cost is typically the audit costs from what you were referring to. And as I mentioned, you could have almost no transactions on your books. And typically the accounting firms that are authorized to do audits for public companies, they're typically not charging less than 50K.
Right.
And you could have no transactions.
Every year.
Right. That's right. That's right. For every year. But so the arrangement that we have with these international stock exchanges is they will accept any licensed CPA. So as long as it's a licensed, professional accountant, then they're able to do the audits. And that opens up the door wide, because when you're limited to these, top tier organizations that can do it for the public markets, they charge what they're going to charge, right? And they'll say that they're taking on a lot more risk, etc. But at the end of the day, there's less players in the market that gets charged what they like. But when we open it up that any CPA could do, instead of 50K, it could be $5,000 or $3,000. Of course, it's going to depend on each company, the complexity of their financials and what's on their books and records. But that can come down significantly. In
So,
terms,
yeah, let's do shorter answers so that we can pop through a bunch of choices here. Um, when you lay it out, you sort of lay out just one step, right? Investors and go tokenize, right? But when we think from angel investor point of view, there's the friends and family period, there's the pre-seed, seed. Now we're starting to see a lot of seed plus series A, right? And I'll draw the line and say, really, the institutional investors are at series A, and that's a certain class and they behave a certain way. And then the angels are down below that in some way. And all the way from mission investors on one side to late seed investors that are typically more financially driven, right? Um, how do you see this happening? You know, the pattern that you're talking about fitting into the stages, right? Is it appropriate to be at a pre-seed level? Are we really talking seed, late seed, pre-series A, seed plus, or are we talking series A as the right place to take on this um, public exposure and this extra set of costs?
yeah, a great question. Okay, so what I'll say is this, is that it's going to depend on the scenario. If we're talking about a company that's backed by an angel group,
Yeah,
and the
not
angel group,
specifically that's what I'm thinking about. I'm going to do a traditional pathway. I'm going to go do angels instead of doing a SPV with the angels. I'm going to go public with yours. Do I do that at pre-seed? Do I do it at seed? Do I do it at seed plus? And where does it make sense from a company point of view and the expenses and cost? And where does it make sense for the angels and them being part of that journey?
yeah, I would say if the angels are involved, then I think seed stage is okay. Pre-seed might be a little bit of a stretch. I'm going to say it depends, because there could be a wide range of pre-seed. Um, but the importance is this, that as I mentioned before, the exit is always the problem that every angel investor is talking about. And at the time when you're investing, why don't you set up your exit when you're investing? That is strategic. And when you're investing, why don't you set up to make sure that your company has access to the maximum amount of capital possible, right? And so that's the concept of a tokenized IPO. And the costs, the cost reward long term, even in the short term, we made a small model comparing the SPV model where you might spend 10K on a SPV and maybe $500 maintenance. I know there's different providers and they may have different costs, but the upfront cost could be pretty close in terms of the SPV versus the tokenized IPO. The tokenized IPO opens up for the exits and a lot more money for additional capital.
Right. And so does it also then create exposure to rule changing craziness in someplace else in the world, right? So one of the problems with several of the engage in startup scenes in other countries is the distance between, one person and the government changing its rules is a little bit shorter than in the United States. So does
That
the
might
fact that we're on this exchange over in, the Caribbean island then translate to some kind of financial risk for the company in any way?
I think that the speed of change may have changed with Trump, but but aside from that, I would say typically the rules, and actually until we introduced the tokenized IPO and had rules adjusted, some of the rules that we would read on the exchanges where we would laugh because they were talking about the floor, like a physical floor where the guys are waving their tickets and stuff like that. So the rules don't change very often. It's highly unlikely for the rules to change, unless we really press for those rules to change, which is a process that we had to go through in order to get to this point. So I wouldn't be too concerned about the rules in these different countries, especially somewhere like the St. Kitts, which is where the Eastern Caribbean Securities Exchange is. It's very stable.
Okay. I'd like to open it up for other folks. If you have a question, please raise your hand and I'll bring you up. actually, maybe I'll bring us down. Anybody have any questions that you want to talk about? Brett, are you still paying attention to this? Brett went to walk his dog. Anybody have a question, please raise your hand because that's how I can actually unmute you. There we go. Ken, you got a thought? You have to raise your hand. There you
Yeah.
go.
I have a handful. Actually, are we going to get a copy of the slides?
I can provide John, I can provide you with a copy. Or Karen, would you be able to put the reading deck in the chat? Is there a chat where people could? Yeah.
Yeah,
We'll
yeah,
put that in. We'll put that in the drop that in the group.
great. Thanks.
Can you put the slide, one of the last slides up? I was going to ask you about one of particular points. It was I think the merger and acquisition increase of chance. My experience has been that it's actually harder to get M&As done when you've got publicly traded shares because the buyers are less interested in basically conforming with the public market requirements for notification in order to get enough shares to have control of the company, as opposed to being able to buy a large block from a private equity investor, venture capital group, or an angel group.
All right, great question. I mean, so this is from Refinitiv, so formerly Thomson Reuters. So you know, they're a data-based driven company, and they have mined all of this data to determine what is happening, you know, what's happening in the markets, and they've determined it's 2.1 times more likely to be involved in an M&A if you're public. So I'm going based off of their data more so than my own personal experience. I'm sure that, you know, there's both situations could happen where, you know, whether it's you know, you could have the situation that you talked about where maybe somebody doesn't want to acquire a public company because they don't want to deal with that reporting. But then there's the vice versa. There's many that would prefer to acquire the public company for various reasons. So this is the data from Refinitiv.
Good.
Vikash has his hand up.
Yeah, I was just curious about because this initiative is mostly outside of the US, with the exchanges outside of the US. So, for people living in the US, what is a good way to experiment with this? Like register with the exchanges? Like, how do we do that? How do we invest through this vehicle?
Yeah, great question. So when there's a company that's being listed that you're interested in investing in, basically you would be able to go to the exchange's website and choose a broker to open an account with. You go through an online account opening process, and once the account is open, then you could fund the account just like you would do with your interactive brokers or E-Trade account, and then you could start to buy and sell. So it's almost identical process as to what you would do in the US. You have to open an account with a registered broker-dealer in that region.
So I haven't done this with Blockstation, but I have done this with the Africa Eats motion in the Mauritius Stock Exchange. And so they just sent me a note saying, you know, register here. I clicked on the thing, filled out the form. They asked for a little paperwork to make sure that I had money to spend and that they knew where the money was coming from because there's a KYC requirement. And then now I can go to the page and use the app to buy stock in Mauritius. Pretty straightforward. It doesn't go to my Schwab account, however.
Exactly. That's correct. And so the same process. They always want to know where the money's coming from because the reality is actually in other countries they're more strict with AML rules than they are in the US because the US imposes, you know, certain requirements on them. So you do have to go through a KYC AML process in order to open up the account. And you know, one of the things that is really good that crypto has done is it's demonstrated how global markets are in terms of when you open up assets to the whole world does participate. And this is exactly what we're doing, but instead of with crypto, it's with securities, it's with startups and early stage companies, which a lot of people want to get their access to, but often they can't if they're not accredited investors.
Right. We have that problem with the Transatlantic Angel Conference because European accreditation rules are fundamentally different than the US, and they can angel invest in Europe, but they can't invest in any of the platforms in the US because the US applies US accreditation rules, and so they can't get through the gate. So
Mm-hmm.
same problem. Romel, your hands is up. You're muted.
Okay, sorry. All
There
right.
you go.
For new startups to get acclimated, what is the best options that you feel, Jay, would get them closer to getting into the securities?
You mean to learn more about how to do a tokenized IPO? Is that what you're
Right,
referring to?
as well as to get in the, public stock exchange.
Okay,
It's-
understood.
I think she's very, very early in asking for sort of a map of the different pathways to move forward as a startup.
Yeah, got it. So typically what we do is we usually have an initial assessment. So we have a requirements criteria or minimum requirements criteria in order to determine if your organization may be a good fit to go and be put in front of different broker dealers. And you might not be there yet. So in terms of like preparing yourself or making sure that you can move in that direction, there's a couple things I would say. First, the first and most important thing is make sure you keep consistent, accurate books and records. Because to go on the stock exchange, you do have to do an audit. And usually what we find with early stage companies is when it's time for them to go to do the audit, they have to go and do years of accounting. But the thing is, if you want to run a good startup, your books and records need to be up to date. Almost, I would say 1 week in arrears is ideal. 1 month in arrears is the max. You should know what's going on in your company and have the reports that you could pull on a month-to-month basis. I would say this is the most important thing. The second thing is to make sure that you're making good documentation in terms of your processes, because the continuity of business is something that that is uh, in tandem with good governance. So you want to have proper governance that your company is its own entity, is going to continue forward, ideally with or without you. That's how you want to think. Although that's going to take some time, you want to think like that. So you want to make sure that you have proper governance, controls and processes and procedures that are in place. And the other thing that I would think about is risk mitigation. So every company has their great dreams and hopes of what they're going to achieve, but thinking about the different risks that are associated with your business, whether it's regulatory risk, competition risk, financial risk, think about all those risks and how you're mitigating them. Because when you're building out a prospectus, the risk section is the biggest part of the prospectus that you're going to have to provide disclosures to the public in terms of exactly what is the risk that the company has. And you should understand how you're going to mitigate those risks for your business so that you don't succumb to them. So that would be my advice.
Prakash has his hand up.
Go ahead.
Prakash, you have your
Yeah.
hand up. You have a question.
I understand. I'm just trying to get it unmuted. Can you hear me now?
Yes,
Yep.
good.
Okay, maybe question. This question is for John. Maybe John. Earlier you said you listed out various other approaches to list in the U.S. market, right? Like
Yeah.
DPO, regulatory A+, OTC, and all that. Is the typical cost of all of that also around the 250K grand?
Well, each one is a different cost, right? Um, when the Canadians came to talk to us about going public on the experimental exchanges, they were talking about it costing somewhere between 25 and 100,000 kind of cost to go public in Canada. In terms of the DPO, the biggest cost is marketing, right? Because you have to do your own, bring people in. So DPOs work best when you have already got a business which has a really large um, customer base, and you're basically getting your own customers to invest in yourself. And the difference between a DPO and crowdfunding is really just which platform you're using, and you have the same problem, right? You have to get your customers or you have to get your audience to engage in this in a significant way. So if you look right now, Blockable is right in the middle of trying to get that to happen, and they've been doing a crowdfunding campaign, and they're about to try to go public on the NASDAQ, and so they're trying to leverage that process of going forward. But again, there's a bunch of costs to do the fundraise, and then there's a bunch of costs that are implied as a basis of now I have to be compliant with that fundraise. So when you are public, there are costs. When you run a SPV, there are costs, and you just have to track those for each one, right? So going public on the US market has accounting and reporting requirements that have costs. Going public in a foreign market on a tokenized thing with Jay has costs. They're different, but the business needs to be able to think those out in their model before they start the journey. Yeah.
Yeah, I completely
Thank
agree.
you.
And just in the case of the crowdfunding or the DPO model, um, in discussion with one of the lead marketers who does a lot of Reg A's or crowdfunding transactions, more on the Reg A transactions, they're usually doing the raise over 12 months, 12 I think to 24 months, I think that they mentioned. And whatever you need to have typically about a 6-figure budget in terms of marketing to start with. And it's something that gains traction over a long period of time. I would say most companies, with the exception of exactly what John said, when a company has a large customer base and they can convert those customers into investors, then the Reg A and those methods are very powerful. But if they don't, then most companies are not really equipped to utilize those methods. And this is when a broker dealer is really, really good. So if you've got a very compelling business, extremely high potential, great story, and you're buttoned up, then a broker dealer could go and get you that capital much quicker than you could probably market on your own, or even with a professional marketer. Probably a broker dealer would be able to do that much quicker.
And they would get you dumb money, just to be clear, right? So we're having a different relationship as an angel investor than we would have as a public person gathered by a broker dealer. Those are different kinds of relationships. Yeah.
Yeah, I would say I won't call it all dumb money because some of it will be institutional money, which is, I won't call it dumb, but it's unengaged. They're not going to be there supporting the startup, holding their hand and working alongside of them. They're going to invest because they believe that you've got your stuff figured out, and with the money, you'll be able to have the right people around you in order to execute your business.
Right. Brent, I'd like to call on you if you're willing. Yeah.
There we go. Yeah, it wouldn't let me unmute.
Yeah, right.
Uh,
So, as an angel investor doing angel investing in this US market, you basically have to wait to the end, right? The
Pretty much, yeah.
chances of something happening in the middle are very, very low. We've had a handful of cases in the Seattle market or Seattle Angel Conference where the Series A people wanted to clear the table, and so they bought out our SPV, which actually was pretty good deal. And that happens in Europe a lot more than it happens in the US, where the series pre-seed and seed investors are bought out by the Series A investors. So when you as a Seattle investor look at, oh, there's this foreign exchange token thing that I can help the company get to. I'm going to put my angel money in, but I'm going to put it over in this tokenized thing instead of an SPV. And I'm going to open up this opportunity. What's your emotional reaction to that?
At this point, personally, there's a lot of complexity here that even though it may be trying to simplify some of the issues or like IPOs and so forth, but realistically, most companies that angels get involved in aren't going to go to an IPO anyway. So there's a lot of complexity here that I would have to understand a lot more of and follow out some case studies and case histories before I would be comfortable going this route. I do think that in the grand scheme of the world and so forth, tokenization and blockchain security on transactions is something that's going to, we're going to see more and more of. In fact, I have a couple investments in some blockchain companies for privacy. So it's interesting.
Let me turn the question then.
Sure.
What experiments or what case studies could we craft that would then produce the set of data that you would like, that would make you feel more comfortable with this pathway, right? So how can we, call together a bunch of investors to run the experiment, to do a pre-seed investment or a seed investment into a couple of companies that follow this pathway? What would that look like? How big of what do you need? How many of what do you need for it to sort of settle into, oh, I see how that works?
Yeah, I don't know what I would answer on that because the first thing I'm going to be interested in the company that I want to invest in before I even seek out what's their exit strategy using an alternative. I have been seeing a few other startups lately that have been trying to do some alternate things, going with the perk and things like that, which at this point I'm not real interested in that company's approach. This I would really be more of wanting to see what companies that I'm looking at that I'm interested in the company itself, and then if they chose to go this route, that would possibly factor into my decision. But
yeah, we would have to jigger things a little bit to make that process work.
Right.
Are you climate investing?
I do some climate investing, yes.
So one of the opportunities for us would be to do like an angel conference around climate investing and then build this into the flow so that the consequence of going through the program, the finalists ended up being registered as part of it as an example of an experiment, right? We have a narrow group of companies, so we weren't doing the bouncing all over the place thing that we do with the regular angel conference. And we would have companies that would have an audience that were non-accredited that would care about the results. And so we would have the opportunity to raise more capital out of that, for example. So does that trigger any, I don't mean to put you on the spot.
Yeah, no, that's fine.
Feel free, but I'm just trying to think in my head, Jay wants to do this thing. He believes things about startups, which I don't think he has enough experience with the nuances of all the little bits of the mess in the middle that we need to sort of lay that out as an experiment. And I'm trying to figure out what that experiment looks like.
Yeah.
All right. So if anything pops in your mind, I'm happy to hear from.
I will, yeah. I'd like to see a little bit more about the company itself and
Yeah.
maybe dig into a few things that they've done. But I do like the idea of securitization of transactions. That's just key.
Yeah, I think that's fundamental. I'll move on to Kelvin. Kelvin, your hand's up. Sorry, you got to unmute yourself. There you
Gotcha.
go.
Thanks, John. I got a question for Jay. Just trying to understand the exit process from the angel's perspective better. So let's say the angel holds on to a token for 5 years, and at that point in time, like all the financials and progress of the company justify a 5x return. So would the exit process be as simple as just placing a sell order on the exchange, or is there some like more networking required, like the angel reaching out to the investor pool from the brokers to find a suitable buyer?
Oh, exactly. It would just be as simple as placing a sell order on the market. And really, it's the progress of the company. The market will determine the price, right? What the price is. So if the company is doing well and progressing, meeting its milestones, and building, and the story is exciting, then there will be, more buyers than sellers per se. And so the price would go up to that. Maybe the 5x is the goal. And you said, maybe when you entered into this company, you said, you know what, I'm looking for a 5x. So when you hit that 5x, maybe that's the point in time that you exit. So it's as simple as putting in a sell order. It's correct.
Thank you.
And so the fundamental problem that I'm worried about is I have my stocks there, but I don't have any motion on the market. There's just not enough people paying attention to my company that when I want to sell, that there's somebody there ready to buy at a reasonable market price, right? And so somehow you have to generate ongoing transactions. And one of the things that Looney Libs has orchestrated in his effort on the Mauritius is he's got an entity that is essentially a market maker that is guaranteeing that there are going to be transactions going on the stocks at that level, right? In that thing, they will be, if there are people buying and selling, they will be buying and selling. They've got a wad of cash that is intending to buy and sell on that market, right?
Yeah.
So how will you address that? Yeah.
So it's the broker dealers that typically do the market making. And market makers are sometimes regulated, sometimes it's not required. And the market makers are not guaranteeing transactions. What they guarantee is a bid and ask spread. So they're willing to buy at $1 and they're willing to sell at $1.10, for example. And so as long as they have some buys and sells populated in the books, when somebody wants to buy, there's something there for them to buy, and when somebody wants to sell, there's something there to sell. So in our markets, there are brokers that will do market making, but it's an arrangement that a company needs to make with the broker dealer, in order to facilitate that.
Okay, cool. Are there other questions or thoughts for this? I think this is a complex idea because it steps outside the box in a couple of different places. And so people have to really sort of reframe the conversation in a bunch of ways. From an investor point of view, from an angel investor point of view, having liquidity matters. Having the ability to raise, like close around by having other people come in matters. For people who are unaccredited, having anchors of angels matter, and all of that can fit into this process. I don't think we've not done enough startups through the process to be able to give us a record of success at the pre-seed and seed level to, move forward quickly with this. I would love to hear people's thoughts on experiments we could do to make that happen, and drive through that. Any last words, Jay?
Yeah, no, definitely appreciate being on. My thought process is this, over the last 6 months, I've been going to a number of different angel investor conferences, and everybody has the same complaint. There's no exits. They don't have a path to exit. They're stuck in a company who is not planning to do an M&A anytime soon. They're not planning to do an IPO anytime soon. And even if the company is doing amazing, the company has no obligation to IPO or M&A. You're at the mercy of that company's, situation. You also have the scenario where a company is doing amazing, but the market conditions are not so good. And so as a result, they're not getting the capital that they need in order to move the company forward. So for all of these reasons, it's my perspective that the exit should be set up from the start. Now, it doesn't have to be, but it's just more strategic from an angel perspective, especially when you know that that company is going to have more access to capital along the way. Because one of the main issues is companies run out of money. And the time horizon between seed and Series A and et cetera is growing, right? But the amount of money available is shrinking, except for some, large organizations like OpenAI that are sucking up all the money. So things are changing. The world is changing. Part of that is because of AI. Part of that is because of blockchain. And angel investing has to change. And if it doesn't change, then I don't believe it's going to be in a good place, because you have to change with the times. The times are now all about artificial intelligence and blockchain and applying these things to create trust, to create automation, to create efficiencies. If you're not using them, then you will be left behind from my perspective. And so what we want to do is we want to educate everybody in terms of how they can utilize these tools, how they can utilize these markets. That's going to make the entire ecosystem much better.
Yep. Well, I'm gonna spend some brain time on how I can generate some experiments around that. So
Perfect.
thanks everyone for coming. We will post this up on the YouTube channel for the Seattle Angel Conference. We have a workshop this evening on Angel 101 for those people that are thinking about joining angel investing. So if you know somebody who wants to do that, then at least tell them there's going to be a recording for that. Thanks for coming. Keep an eye on the meetup group for more events. Bye-bye.
Thank you. Bye-bye.